All right, everyone. Thank you for tuning in tonight. Good afternoon. My name is John Patton, and I'm the marketing director for Capitalist Times, the publishing company for Deep Dive Investing. First, I want to thank everyone for taking the time out of their busy holiday schedule and for spending an hour and a half with us and learning a little bit more about our Deep Dive product and joining us for this question and answer session. Today is our Thanksgiving Eve live panel discussion with Deep Dive Investing co-editors Roger Conrad and Elliot Gu. Before we jump in, though, I do want to say if you have any issues, if you're having any audio problems, please just send us a message in the chat and we'd be happy to do whatever we can to help out and answer any questions. And the phone number right there on the screen that you're seeing is also available if you want to just pick up the phone and call to get support on any technical items. So I'm really pleased today to introduce Roger and Elliot. It's an honor to be working with them. And I just want to start out by giving a little bit of an intro and background on both of them. And then we'll jump into kind of our conversation is how we're going to approach this today. So let me start with you, Roger. Roger has made a living providing investment advice on utilities, telecoms, and other essential services stocks for more than 30 years. His published advisories have regularly earned high marks from independent ratings services, including the Hulbert Financial Digest, and more importantly, from his many subscribers like you. Elliot Gu, who's also here today. Elliot has nearly 20 years of experience as an editor and publisher of investment advisories and founded one of the first and only advisories dedicated solely to energy markets. He's also written 2 investment books published by Prentice Hall covering investment topics as varied as energy, agriculture, financials, and the emerging markets. And of course, many of you are familiar with Roger and Elliot's work over the past 5 years through Capitalist Times, other services including Energy and Income Advisor, Pig versus Bear, and Conrad's Utility Investing. And so we want to spend a little time, first of all, telling you more about our new service, Deep Dive Investing. So Deep Dive Investing is Capitalist Times' newest service. We launched it in March. However, this advisory has been in development for years, actually. It's the product of a wide-ranging weekly investment meeting that Roger, Elliot, and managing editor Peter Stoss have been having covering key investment and economic trends, themes, and ideas. In Deep Dive, Roger and Elliot are presenting the most powerful investment themes they've identified in the form of online presentations, covering all of what you need to know, including the big picture, driving each theme, the stocks to buy, how and at what price to buy these stocks, that's really important, and also the risk level of those recommendations and target prices and objectives. So it's a soup to nuts service that gives you a lot of hands-on information and specific direction for the themes and the picks associated with those themes. So in today's conversation in our webinar, I'm going to be asking a series of questions, and I hope they're enjoyable and entertaining and engaging for all of you who are tuned in, to both Roger and Elliot regarding their outlook for 2018, investment themes and trends that they're watching now. And then we'll open it up to your questions, all of those of you who are here today. And so please, when you're doing that, start thinking of your questions now. And we'll try to get to as many as we can, and we'll do it in the order that we receive them. Or if there's a particular, no, we'll just answer them in the order. And we'll just pose those to Roger and Elliot after we wrap up our kind of panel here. And just as a reminder, this interview is being recorded so that we can get this into your inboxes right afterwards. So you can review this and share it around, and we'll let you know as soon as that's available. So with that, we're going to jump right into our first kind of theme or our question for tonight's discussion. And so, Roger, this is going to be directed at you first. And so here's the question. The S&P 500 hit a new record high this week and is up more than 18% so far this year. The U.S. economy is likely has expanded at a 2.5% annual pace or better this year. Yet the bull market will enter its 10th year next spring, and stocks are about as expensive as they've been at any time since the height of the tech bubble in the late 90s, 1999 and 2000 specifically. As they approach the end of 2017, what do you see for the new year? Can the bull market continue? And I know this is something we've been discussing a lot internally, but I really want to get this out here to our attendees. Roger, let's start with you. What are your thoughts?
Okay, well, thanks, John, and thanks everybody for tuning in on this briefing today, right before Thanksgiving. We really appreciate it. I think the bull market can continue into the next year. I'm still seeing a number of good stocks to buy, and we've been identifying them in deep dive investing as well as our other advisories. I mean, you make a really good point about valuations, which basically are indicating very high investor expectations, and whether those are conscious expectations or whether they're baked in by some of the other phenomenon we're seeing in the marketplace, such as the rise of passive investing, where you have billions and billions of dollars controlled by basically robotic algorithms that nobody really knows how they're going to react in various environments, but we have seen on occasion some really stepped up volatility. So, these expectations, these very high prices, these very high valuations mean added risk for the market. So, again, we're seeing some values, some good values out there. We're not running for the hills, but we are doing a couple of things that I've never really done that much of in the past. And one of them is basically taking profits on particularly very big winners, and whether they're partial profits or all and out sells of recommendations. We're doing a lot more of those types of things. And again, this is, I think, when you get to this stage of a bull market, you want to be very opportunistic, and that's definitely a big part of it. Utilities I write a lot about, I've been involved with for over 30 years, and they tend to be, my favorite holding period is forever, particularly with some of the better ones there. But even in that group, you can do well, taking some profits. So I'm really taking that into consideration as I look at stuff in all of our advisories and deep dive investing in particular. We tell you when to buy, but we're also very concerned with when to sell, particularly at this point in the market. And I'm also very suspicious of value traps. And a value trap is distinguished from a value in that it's more of a hold and hope kind of situation. So, I'm not afraid to cut things. I'm probably much more willing to cut things loose that don't work out, or that when I see an assumption that I've made not holding up. In the beginning of a bull market, you can afford to be a little early with some of the stocks. At the end of a bull market, though, and particularly in a bear market, as we all know, it's always a handful of the biggest losers that are really what blow holes in a portfolio. So you don't do yourself any favors by just buying a stock because it's cheap. You want to make sure that there is actual true value there, where a company is getting stronger as a business and has some definite visibility on growth and can make that growth happen even if the macro conditions change. So if we get to the end of the bull market, cost of capital gets more expensive, it's not going to sink necessarily the stock. So that's the difference between a value and a value trap. And again, I think that's one thing that as we get to the end of this, or as this bull market gets aged, and I don't want to say the end of it, because I do think it can continue further, but these are issues that we really have to keep in mind. And, I think if there's one thing that's changed for me over the last year or two, it's that I've become a little bit more active in terms of trying to help people manage their winners. And, fortunately, we've been blessed to have a number in this bull market. And again, I think how we get through this, how we profit the most from this rest of this bull market, and how we manage ourselves into what lies beyond, matters to a large extent. How we manage our winners today. So that's
yeah.
long-winded answer, but that's that's kind of how I'm coming around to things in all the advisories, particularly deep dive investing, where we've really taken this audio visual approach, really getting into certain areas that we still feel are good values.
Yeah. Well, thank you, Roger. And Elliot, what's your forecast for 2018? What do you see ahead?
Well, I generally agree with Roger. We will see a continuation of this bull market in stocks. I do think we're getting late in the bull market, and it's actually a very typical cycle in many ways, in the sense that typically the last 2 years of a bull market, the average gain for the S&P over the past 80 years and the last 2 years of a bull market, of which there have been 12, is about 58%, including dividends for the S&P 500. So the fact is that bull markets almost always end with a bang, not a whimper. The last 2 years of a bull market almost always start with the S&P looking at like it's at historically stretched valuations. So I think we're kind of in that euphoric phase, that final sort of melt up phase of this bull market. The one thing I'd point to is that historically, bull markets in the S&P 500 have not reached a peak much more than a year before the U.S. economy enters recession. So the real question here is, do I see risk of recession happening over the next 12 months? And right now, I got to tell you, I see exactly the opposite. Not only do I see no recession likely, I'm seeing accelerating growth not only here in the United States, but all over the world, in the major economies all over the world. I look at a number of different indicators to assess that, many of which we talk about a lot in deep dive investing. But if you look at, for example, the U.S. Leading Economic Index put out by the Conference Board every month, typically in the 12 months before recession, you'll see a lot of negative month-over-month readings in that. I think we've seen one out of the last 12 months, which has never happened before in the lead up to a recession. Typically, you see a lot of negative readings. So I just don't see that happening. Looking at Europe, the Eurozone is coming back from a tough period a few years ago during the debt crisis. And even Japan, which has sort of been the default global sick man of the world in terms of economics, is doing a lot better. They just had a big election in Japan, and I think we're going to see a continuation of the policies that we've seen over the last few years. Economic growth is picking up finally in Japan. So you really got all three of the developed sort of economies perking up at the same time. What I do think you're going to see, though, is a shift, a change in leadership in the market, away from these pure play growth companies, in particular a lot of technology stocks, and into more value-oriented plays. Value plays, and this may seem a little paradoxical, but value typically beats growth when the economy perks up. Growth tends to outperform when the economy is weak. And I think you're going to see that this coming year, and I think you're going to see a big shift in favor of value stocks over growth stocks, which would be a major shift from what we've seen over the last couple of years.
Great. And just to follow up on that question here, Roger, you highlighted the fact that many income stocks are extremely expensive right now. However, you recently wrote about one high yield group in deep dive investing where you're still seeing some value, namely the yield cos. Could you elaborate a little for us on that?
Yeah, certainly. Yieldcos are kind of like MLPs in a way, or master limited partnerships, and we've talked a lot about those in the past. The twist is they're not actually organized as MLPs. They're corporations for your tax purposes. But they do have sponsors, and they're mainly utilities, developers of power and so forth, that are trying to recycle their capital by spinning down contracted, and in some cases contracted as long as 20, 30 years, contracted power plants. And a lot of the yieldcos are focused on areas of the market that are more or less exempt from market forces in terms of being a generation source, such as wind and solar, which are mandated in many states. Of course, costs have come down as well. That's improved the economics. This is a group that really took it on the chin about a year ago, I think a lot of people were kind of lumping them in with some of the MLP situations that, MLPs have been very, very popular for a while, and we've seen a lot of initial public offerings, and that we believe many of them really shouldn't have ever been cobbled together as businesses in the first place, and are probably headed for the dustbin, either as preferably as mergers, but perhaps as bankruptcy candidates. Well, the yieldcos got kind of lumped in with that. I mean, I think that's not unreasonable that they were, because they sort of are governed by the same kind of dynamics. They have to, in order to grow, they have to absorb more power plants, and because they do pay out as yieldcos, they pay out most of their cash flow or free cash flow as dividends. They have to rely on outside capital to get there. But what we've seen over the last year is a lot of support from the primary sponsors of these things, and we've seen investors take another look at them. And I still see, I did a report on these a few months ago. We've done pretty well with those picks so far. We have been recommending a number of these things have really run up well above where we have been recommending them as buys. But I do think there are a number of still some interesting plays out there. When I mentioned value versus value trap, a value trap would be a company that is unable to realize any kind of growth, and then they look cheap, but then at the end of the day they wind up getting cheaper. A value, though, one of the hallmarks of a value, and one of the things that makes many of these yieldcos values, is the fact that they're paying these nice distributions. So they pay you to own them. And now that we're seeing some more interest in these companies, we're also seeing some takeovers. We've seen a couple in the last few months with a company called Algonquin becoming the basic parent of a company called Atlantica Yield, which had a sponsor that was a bankrupt Spanish utility company. So Atlantica's in a much better shape because of that now, is now returning to growth. Also, the Terraform companies, which were acquired by Brookfield, a large Canadian company that we've recommended many parts of over the years. So they've gotten a much better sponsor. So they're on a good track for growth. I think the next one that we could see that happen to would be 8.3 Energy, and that's one that's owned by the sponsors are SunPower and First Solar, and both of these companies, contrary to popular delusion, are very much starved for cash right now. So they're looking to sell this particular part of their operation, and I think that will catapult this thing to stronger growth. So you have a really good value proposition of high yields with a lot of these things, and growing distributions backed by strong parents, and that's the very definition of I think a value, particularly here at the end of, as we've been through this, going through this bull market, and so many other things looking so expensive. These particular companies have a lot of growth ahead, and also at the same time, because they do have their current distributions and values are anchored by these 20 to 30 year contracts, many of which are with utilities, some with government entities, and they're just basically running these wind and solar facilities to feed these cash flows. They have a very good business model that I think can sustain, even if things do go south, and even if we do see a bear market slow things down in the broader economy, make it more expensive for companies to borrow and sell stock, and thereby fund growth. So yeah, I'm pretty excited about this group. I think we do have to watch the valuations and so forth, and there have been opportunities actually to take profits in some of the names we've recommended, and thereby being opportunistic, because a lot of times when something gets really expensive in this market for a short time, then the momentum changes against it. There's maybe some disappointment, the prices come down, and it's a great buying opportunity. So again, a little bit more active investing than income investors in general have been used to in the past, but I think it really can pay big dividends here, literally and figuratively, in this stage of the bull market, where expectations are so volatile, prices, there's a lot more volatility in a lot of these names than we're used to seeing. And that gives us opportunities to buy low and sell high. And sometimes several times in the same name, even over the course of a period of 12 to 18 months. So I'm pretty excited about this group. And we do, when we make an original recommendation, we do the full-on research. We will update often with another audio-visual update, and I've done that with several of the groups over the recently, and that of course gives us an opportunity to be more active. We have a portfolio that has our best recommendations in it, and we also have an idea bank where basically you can see what's happened with every recommendation in the service. So again, we're very excited about Deep Dive, and I'm very excited about the yieldcos, and I look forward to talking about them quite a bit more and taking advantage of the volatility in a group that really does present great value at this stage in the bull market.
Great. So Roger, and thank you for the response there. Elliot, I want to build off this. So Elliot, you mentioned that you expect value stocks to take over market leadership in 2018. But so far this year, and for that matter over the past 18 months, it's been all about growth stocks like those in the tech sector. Why do you think that's going to change, and how do we identify attractive value stocks?
Yeah, absolutely. It's been the year of growth so far. In fact, I read a statistic not long ago where something like 90% of the S&P 500's return so far this year are down to one sector and one sector alone, and that's information technology. And what's interesting is that historically, growth stocks are basically what we would call secular growth companies. So these are firms that can generate earnings growth pretty much regardless of whether the U.S. economy is growing at 1% or 5% annualized pace. A classic example might be a company like an Amazon.com. Obviously, consumers are increasingly, here we are just a couple days before Black Friday here in the U.S., and, a lot of consumers aren't going to go to the mall this year because they're going to buy stuff online. And we've seen, retail spending has been quite weak over the last few years, but online sales of everything have just soared. And so that's a secular theme, that more money is shifting towards Amazon's type of platform in terms of being an online retailer, and away from the Macy's and Nordstroms of the world. So that's an example of a secular growth theme. That's a company that can generate earnings growth, even without help from the cycle, from the U.S. economic cycle. And in contrast, value companies tend to be more cyclical industries. Industrials, energy, financials being some of the big groups within the value sector. And those do need help from the cycle. They need the U.S. economy. They need the global economy to be growing. But what we're seeing right now is just that. We're seeing synchronized growth, not only here in the United States where economic growth is picking up. I think you mentioned in your opening remarks that U.S. economic growth is going to be around 2.5% in 2017, which is the fastest pace in a couple of years. But I also think that you may even see a pickup in that growth rate into 2018 in the U.S. Outside the U.S., as I said, Europe looking better, even Japan looking better, and China also perking up here after a couple of years of, what's for them sort of substandard growth, less than 7% annualized. Obviously, for the U.S., that would be pretty amazing. So I think you're seeing that cyclical pickup, and that's going to support these more cyclical value type names. That's the big shift that has historically driven investors out of growth stocks and into value stocks. And typically these cycles last for years. And in fact, we've just begun to see over the last few months, some months where value stocks are outperforming growth. And I think that's just sort of the opening act of this shift in leadership. One thing I would say, though, is that I think the other important question to ask yourself, and this is something I did in Deep Dive Investing just a week or two ago, earlier this month, was look at, okay, value stocks as a whole have underperformed growth stocks. And typically the way value stocks are identified is that they trade at low valuations on metrics like price to earnings, the PE ratio, price to sales, and price to book. But in many ways, I think all of those traditional valuation metrics that we all have used over the years are somewhat flawed, and it's because none of them include what's one of the most important fundamentals for a company right now. Think about it. Think about history, the financial history. Think about all the big name companies that have failed over the years. Whether it's a WorldCom or an Enron, or even going back further in time than that. Usually the reason that companies fail is because they have too much debt. They're overextended in terms of leverage. They have, maybe there's a downturn in the economy, and they end up, even names like Lehman Brothers, right? They had too much leverage when 2008 rolled around, and they just couldn't handle it when the real estate industry blew up. So why do we use valuation metrics that don't take debt into account? It makes no sense. Why would you look at just the company's value of the company's stock when it makes a big difference whether that company has 100% debt to cap ratio or 20% debt to cap ratio, or even a net cash position? So one of the things I'm looking at is there are some valuation metrics that have worked even in this growth favoring market. And one of them is enterprise value to free cash flow, which basically enterprise value is the value of a company's common stock plus the value of their debt net of cash, compared to free cash flow, which is the amount of cash flow they have left over after taking care of their basic capital spending needs. This one metric over the past 18 months in a market that is otherwise heavily favored growth has outperformed the S&P 500 by nearly 10 percentage points. And I've identified a lot of names that are attractive on this valuation metric and that I think could do even better as the market's general focus shifts back from growth to value in 2018.
Roger, you just came back from an energy conference in Texas earlier this year, very excited about something few people can even recognize as an energy play, and that's water. Why is water so crucial to the energy business, and are there still plays on this theme that look attractive?
Yeah, thanks, John. Just to talk about just briefly what we are doing, and you mentioned an energy conference in Texas. That was a conference about the Permian Basin, which is one of the really hot areas in the world probably the hottest area in the world in terms of fresh oil production. And I think one thing a lot of people don't understand is that about the energy market is that it's become a game of market share. It's not so much trying to pick what the price of oil is going to be at some point. It's where that oil is going to be produced, and particularly when you're talking about individual names. So, Elliot and I have been getting out, I think, a lot to conferences around the country. They're not all to do with oil and gas. For example, I was at Edison Electric Institute annual financial conference, which is the big electric utilities of the world, and that was earlier this month. But energy has certainly been a big focus for us. We have been going to the MLP conference every year in Orlando. And we've been more or less, kind of doing this in the various pubs, putting together our advisories, publications. We've been putting together, big reports on our findings and our recommendations and so forth from those conferences. And in the case of MLPA, we've distributed that to our Energy and Income Advisor readers. In the case of Conrad Utility and Edison Electric Institute, obviously, Conrad Utility Investor, the target. I mean, one of the things that we're really excited about with deep dive investing is that it's pretty much this kind of thing all the time. And this is a pretty good example of that, this conference in the Permian, where a lot of people were talking about something that really had been kind of an afterthought, I think, for most people. And that's water, as you say. Water. And I cover a lot of water utilities, and I have for many years. Water is not exactly what you'd call a growth business. In fact, when it comes to utilities, the utilities have been growing from the investor-owned companies have been growing by acquiring smaller water utilities. We're not using more water per capita in the U.S. In fact, there's a lot of emphasis on conservation Certainly anybody that lives in California can attest to that over the last few years. And that's basically the trend. So this has been a business that has definitely attracted a lot of investors. A lot of people have bought water utilities, but it's hard to see a lot of upside from some of the valuations we're seeing there. The water in terms of oil and gas drilling and hydraulic fracturing in specific, which a lot of people refer to as fracking, this is a completely different story. This is actually really the two big things that you need for drilling are hydraulic fracturing, or water and sand. And there's a lot of sand out there. Water, on the other hand, has become a lot more difficult to get your hands on in terms of being economic, and particularly as the size of these wells have grown, have been increased, and that's how efficiency gains have been realized. Costs are a very big part of winning market share in the global energy business. And one reason that places like the Permian Basin and the Scoop Stack in Oklahoma, which was another conference we went to about 6 months before the Permian, water is really an essential element. A lot of people are talking about it. Of course, in Oklahoma, and also to an extent in Texas, people were talking about earthquakes. And a lot of people have been concerned about growing intensity of earthquakes, growing number of earthquakes in places where there's a lot of hydraulic fracturing. And of course, a lot of people have been concerned that the actual hydraulic fracturing is what has been causing these earthquakes. Well, what we've seen is that what's been discovered is it's not the drilling, but it's what happens to wastewater afterwards, after the drilling. So, when you drill, when you use a lot of water, you have a lot of wastewater. And the traditional practice has been just to put it on trucks, haul it over to some hole in the ground. Sometimes it's an extinct oil and gas well, and just dump the water in. And what Oklahoma has found is that is what's, with this massive amount of weight that you see being dumped into these fissures, has caused a massive change in the seismology. So that's one factor. And they're trying to see what can be done to limit amounts of water that's dumped into these giant holes, or in fact, in some cases, they're forbidding the practice. So that's one big challenge now to hydraulic fracturing. The other thing is that that of course with the earthquakes, but the other thing is, the more drilling that's going on, the higher the costs are for bringing enough water in to make these wells work. And just to give you a couple of statistics, and these are from a report by Bluefield Research, which appeared in E&P magazine, which I'm a big fan of. They with a flat rig count of 650, 28.8 billion barrels of water will be required between now and 2026. And that's 20.8 billion barrels. That's a lot of water. Last year fracturing consumed 1.3 billion barrels and produced 574 million barrels of water for disposal. So again, that's a lot of water that's got to be dumped into for disposal. Dumped into these disposal wells, and again, creating a lot of problem with seismology. In terms of cost, the authors of this study project $136 billion to procure, dispose, transport the water that's needed to make these wells happen. And in some parts of the country, such as Pennsylvania, Ohio, they have limited well disposal options. The all-in costs are as much as $20 a barrel. So $20 a barrel at $100 oil doesn't seem like it's not, well, it's still a fairly large figure. But when you get if it's costing you $20 a barrel of oil equivalent to drill at $50, $60 oil, that's a huge bite out of your economics. And the solution is recycling this water. And you can basically, with some of the designs, by building a large facility that a lot of companies can use, piping the water in, recycling it, sending it back to the well for use. Again, you can actually change the chemistry to make it more reactive to the resource, so you can get better yields from your wells. The savings are estimated as high as 78%. So you can bring that, potentially you can bring that $20 down to something in the low single digits, even under fairly conservative methodology. So there's a tremendous push to get more water recycled. And it's basically economics. I remember one of the quotes that stands out to me at this particular conference was one of the analysts saying, well, we're on the side of angels here by recycling our water, but does this really make economic sense to do? And I think more and more companies are turning to this right now, or at least over the last year or so. About 6% of what's called produced water is being treated and was treated and reused. This study by Bluefield projects that to rise as much as 16%. So that's over the next few years. So that's a tremendous amount with recycling of flowback water at 90% over that same period. So 90% by 2026, this study projects the water that comes out of the wastewater or flowback, as it's called, will be recycled and not dumped into these disposal wells. So that's a huge business. My deep dive investing report on this talked about a number of names. Some of them are technology names. Some of them are producers that are actually, I think, pretty good candidates for spinning off their infrastructure as MLPs going forward. So that's a tremendous opportunity for them to recycle capital to gain, I think, a pretty good bump in their share prices from a successful deal, and also an opportunity for us investors to cash in on a very MLP-able business, a business that will generate a lot of fees, that will be in increasing demand going forward, and thereby generating pretty good income as well as growth. So this is an area I'm pretty excited about. Again, from a lot of different angles. There's the technology as well as for income, and we just updated some of the names. A couple of them actually had gotten to that point that as I've been talking about, where it makes sense to take a little money off the table, and so we've been advising people to do that, and we're looking for the next opportunity to buy them, because I think this is a tremendous opportunity. It's going to obviously be around for a long time, and it's going to help, I think, also for those of you who are Energy and Income Advisor subscribers. I think it's also going to make our picks in the Permian and some of these other areas much more competitive than a lot of people are talking about now. A lot of people are talking about maybe some of these areas are kind of overbid and too expensive and breaking down and so forth. I think this is one thing that a lot of these people are overlooking, that can really drive down costs further, can really actually make it able to increase the supply of water, so it's actually making it able to drill even larger and even more efficient wells. Very excited about it.
Great. That was quite an answer, Roger. I really appreciate your digging into the different areas of the technology. And Elliot, I've got a question for you. Elliot, you've sounded pretty bullish on the market and the economy for 2018. However, you've also said there's some trouble brewing in the auto industry, one of the most important. What's going on, and how do we avoid the pitfalls here?
Sure. Well, the automobile industry, as you said, is a very important industry for the U.S. economy. And what we've seen over the last few years is basically a boom. And by that, I mean that we've seen United States car sales, new car sales, up over 17 million annualized units, which is pretty close to a record level. And some of that, of course, is because car sales ground to a halt during the Great Recession, about 10 years ago. And so the average age of your U.S. automobiles was becoming longer. It was becoming older. They were becoming older and older, the existing fleet of automobiles, because a lot of people put off buying a car, in 2008, 2009. So when the economy did start to recover, we did see a huge replacement cycle, a lot of pent-up demand for cars. So that's sort of the good side of it. The bad side of it, though, is, if you will, is there's been a lot of reliance on very aggressive financing. And by that, I mean that we've seen a huge surge in the incidence of leasing cars. So what's happening is they're very attractive terms on leases where instead of buying the car outright, you get the car, you put a very small down payment down usually, or sometimes nothing at all. And then you turn the car back into the dealer after 3 years' time. And what you're really financing is the loss in the value of the car between the new car price and the residual value after 3 years. So in a lot of cases, those lease terms can be really, really attractive and can allow consumers to get into a brand new car every 3 years. They've become extraordinarily popular. What I mean by that is that historically, leases from 2000 all the way up until just about 3 or 4 years ago made up somewhere between 15 and 20% of all car sales, 20% being the very, very high end. The average was more like 15, 17% of all new car sales were financed by leases historically. In this most current cycle, we've seen the lease penetration rate get up over 30%. So almost 1/3 of all new cars are being financed with these leases. We've also seen automakers over the last couple of years get into some pretty aggressive financing. We're seeing a big surge in the number of new cars sold to subprime borrowers. These are, you might remember the word subprime from the real estate boom and bust years. But you're seeing pretty easy financing over the last few years, even for those who have credit scores in the low 500s, which historically have not had easy access to credit, because you have a lot of these consumer finance companies which are packaging these automobile loans up into basically bonds and selling off these asset-backed securities as a product to other investors. And I know for many of you that probably sounds kind of eerily familiar, because that's exactly what a lot of these banks were doing back during the boom days of the real estate boom, packaging up these subprime mortgages into securities. Well, that's happening today, but it's not happening in real estate so much. It's happening in the auto market. So the problem is there are a couple of problems. One is I think the financing situation has become a bit stretched, and a lot of the growth in new car sales is at the low end of the credit spectrum. And therefore, we've seen a number of these consumer financing companies report increases in default rates, increases in the need to go out and repossess people's cars. And this, to me, is a big warning sign that there's not a whole lot of upside to new car sales. The other side of the equation, which I think is maybe even the more dangerous of this, is, as I said, leases have become extremely important, extremely popular over the last few years. And the problem with that is that when somebody leases a car, 3 years later, that nearly new car, or we'll call it lightly used car, if you will, comes right back on the market. Usually with relatively low mileage, it comes, sort of sub 40,000 miles, in many cases sub 30,000 miles after 3 years. Those cars come right back on the market and compete with new cars for buyers' attention. And what we're seeing over the next couple of years is an off-lease tsunami, a true tidal wave of these relatively new leased cars that are coming back into the market. This year it was up about 500,000 to 750,000 over 2016. Next year it's going to be up another 1 million units. We're going to get up to where we're having as much as 5 to 5.2 million off-lease vehicles coming into the U.S. car market per year by 2019, 2020. So that's already having an effect on depressing used car prices, pushing down the price of pushing down the price of used cars. And of course, it's ultimately beginning to erode demand for new cars, because a lot of consumers are opting to purchase a cheaper used car rather than going for a new car. So there are a number of ways to play this that I've discussed in Deep Dive. One of them is to look for companies that are vulnerable. One of the things I like to do in a bull market is to look for pockets of weakness that might be good short sale candidates or stocks that I want to bet against with options, put options, for example, during a bear market. The other thing, though, is it's really supporting the used car retailers. One name I've written about a lot is CarMax, symbol KMX there. They're the largest used car retailer in the U.S., and they actually benefit from this, because if you think about all those nearly new off-lease vehicles coming into the market, CarMax buys those cars and resells them to consumers for a markup, the volume of used cars, the popularity of purchasing used cars rather than new cars directly benefits CarMax, though it of course hurts the big automakers, and it hurts in particular a lot of the auto parts manufacturing companies. So that's the basics of that trend, and it's something that we already have a few recommendations in, and we're likely to have more going forward.
Great, thanks, Elliot. And I'm excited to say that we have some questions coming in already, but we've covered a lot of ground already in today's webinar, and we're going to transition now and start to answer the questions that we're getting from folks that are joining us today. So if you haven't already typed in a question, we have a nice little list already here. Please go ahead and type one in. There's a little chat icon. You can just type that in, or the Q&A icon, and just send that over our way. So I'll start in kind of chronological order. First question answered, first one received. So we have a question from James, and he's asking a question about BPL. So BPL has been a disaster recently, many dollars beyond the dream price, deep into nightmare territory for early buyers. I have read your questions, why the stock is down, in your opinion, that it should recover in the future. The question here is, he actually hit enter before he was able to get the full question out. What he wants to ask is, what is driving it down on a daily basis? So today it's up, but for the past weeks it's been down daily. Seems old news would drive down the price to its bottom and languish there until there's new news. So fairly reasonable thought here. Why the continuous daily drop? And thank you.
Well, I'll take that. And basically, I think one thing that's happened with Buckeye is that it's been following the rest of the MLP universe. We've seen almost on a daily basis MLPs getting hit. I think part of that is because a questioning perhaps by investors of whether this is a viable business model. We've made the argument that we think it is. We've also made the argument that we think that a number of these MLPs have taken on too much debt over the last several years, and we're seeing it come home to roost as some of their legacy assets continue to outperform at $50 to $60 oil, and we've seen distribution cuts. Now, Buckeye isn't one of those, but what it did do right around the time it announced earnings earlier this month, was announced that it was suspending distribution increases. So it had been increasing its distribution every quarter since the beginning of 2013. It stopped. It did not raise this most recent quarter, and the reason cited was that they wanted to build more distribution coverage. They have been running pretty thin distribution coverage, a little bit under 1-to-1 or right around that 1-to-1 mark. I think they did offer some pretty good reasons why we should expect them to continue at least 1-to-1 coverage, one of which being that some of the shortfall they had in third quarter distributable cash flow below the distribution had to do with storms that hit a number of their facilities in Texas and also in the Caribbean that interrupted some of the revenue there. I think some of the factors that are causing that tight coverage are perhaps a little bit more lasting, such as some of the backwardation we've seen in the oil market. They are one of the big areas that they expect to see growth in going forward is going to be in energy storage, oil storage, and to that end they made that VTTI acquisition, came in half partnered with a company called Vitol SA, which is a major energy marketer around the world. And I think there's been some concern that large storage exposure would hurt them if backwardation does continue. Now, we've seen, of course, backwardation in contango, the oil market, go between those in several times in recent years. That's sort of a natural way that things work. And when when we get to backwardation, where the current price of energy is worth more than the future price, the value of storage obviously obviously declines. Well, Buckeye's facilities are in some of the most widely trafficked areas of the world. So they are also mostly long-term contracted. So they're really not they're not, I don't think, as exposed to this trend as might be apparent in the stock price, but it does make sense to me that you would see MLPs in general and Buckeye in particular continue to get pounded on as long as these are concerns. Now, the other thing that's happening, obviously, is that there's a lot more volatility, in the market today. So when a stock starts moving in one direction, it tends to continue moving in that direction. What's important to us here is, how is this business holding up, and to what extent can this decline in Buckeye's unit price affect its underlying business? So, is this drop in the stock going to mandate them pulling in their horns further? Could it even cause them to actually reduce their distribution? Well, I think it's pretty clear that when these MLPs actually cut their distributions, it's basically a last resort, because you tend to see these things really take it on the chin. But this is something that we're definitely watching when we see the earnings. Now, we don't really like to see it. We don't like to see an ugly chart like this, and we're definitely concerned about it. But at this point, it seems to us, just based on what we've seen, based on what the company's underlying business is, which is about 98% margins that are not depending on commodity prices, so they're pretty much locked in. Based on these factors, we think that they can, and also the fact they don't have a whole lot of debt, we think that they can weather the storm, and we think that the buyers will come back to the name, and that we'll eventually get back to those higher prices. If you look at the stock price, you can see that it's been up and down all over the place in recent years. Right now, it's trading about where it was when oil was sub 30. To us, that seems kind of an extreme and more driven by sentiment than anything else, because oil is obviously at a much higher price than it was back in early part of 2016. But again, this is a name we're watching, and I think if you're worried about risk, it is that is there a reason why they might trim the distribution, because to shepherd more capital, but on the other side, this is a company that has they did suspend distribution growth back in 2012, and that was also in a period of weakness for storage. It was also a period right after they'd made a major acquisition, so used a lot of capital, and they were trying to readjust their business. They also had a lot of marketing at the time, and which was a very big, a very volatile business for them. They don't have that kind of exposure anymore. So I think there's a lot of good reasons to be hopeful here, and a lot of good reasons to stay with that, and to expect that the bounce that we're seeing today will go forward. But again, this is a name we are keeping a close watch on, as we are many of the MLP names. But we think at this point that this is one of the stronger ones, and we think it's more guilt by association than anything else driving it down.
Great. And James, I hope that answered your question, and thank you for the question. The next question, and Elliot, I think this is a good one for you. I'll give Roger a little time to have a sip of water over there. Here's a question from Jim. He talks about our 4 major services offered at Capitalist Times: Energy Income Advisor, Conrad's Utility Investor, Pig versus Bear, and now the new Deep Dive. And Jim wants us to compare and contrast the objectives and timeframes across these different products. And he wants to know how to decide which ones best match his personal objectives. So Roger and Elliot, it would be great if you guys could walk through that and help Jim to kind of understand why Deep Dive is different and what makes it different.
Sure, absolutely. And that's actually a really good question. And I'll go through 3 of them, and I'll let Roger talk about Conrad's Utility Investor separately. But simply put, Energy and Income Advisor is firmly focused on the energy markets. We do cover a few sectors that are sort of, kind of related to energy. For example, in the past, when oil prices were falling, we did get involved into some non-energy sectors that are heavily influenced by oil prices, like the airlines, for example. We made a profitable recommendation there. The timeframes in Energy and Income Advisor, it really, for the most part, we're thinking long-term there. This is much more of an investing service rather than a trading service. And we do actually have multiple model portfolios focused on investors, aimed at investors with different risk tolerances and objectives. For example, we have a list of income recommendations, which are for investors more interested in, high current income, either distributions from MLPs or dividends from some energy companies. And we have more of a growth-focused name, which would be more of a growth-focused list, which is more aggressive in many cases and more aimed at those looking for capital gains rather than dividends. We also divide up portfolios into aggressive and conservative recommendations. The conservatives are really the more stable names, the sort of blue chip names within the industry. And the aggressives, of course, as the name implies, would be companies that we think have a lot of upside potential, but also carry higher risk, either more volatility or more sort of a higher risk, higher reward type of scenario. So it's definitely an investing service. It is firmly focused on the energy markets, everything energy, from MLPs to international energy companies to plain old U.S. energy companies, everything in that industry. And we do have portfolios aimed at investors with different risk tolerances. As far as deep dive investing, which is our newest publication, that we're talking about today, deep dive investing is much more. It's a much broader service than Energy and Income Advisor, in the sense that we cover all sectors, all industry groups in the service. For example, we've had, Roger talked about water investments. I talked about, off-lease vehicles, auto market investments. We've covered industrials, we've covered financials, we've covered yield codes, which Roger also talked about. Roger also just put up something about real estate investment trusts. We pretty much cover the gambit of the investment area of different investment areas. We even talk about bonds at times. I know Rogers has in the works a report on the junk bond market that's going up on the deep dive investing site, if it hasn't already. So we cover a wide range of industries. And the genesis of deep dive investing is that, Roger and I for years, for many, many years, have been meeting at least once a week, either in person or via a conference call. Often with Peter Stas, who's our managing editor, who covers the MLP industry in particular. And we talk about an awful lot of different industry groups, trends, themes that we think are profitable. And we do a lot of debating. We do a lot of sort of devil's advocate playing with each other in terms of what are the best ideas. And Deep Dive is really presenting you the best ideas, the best themes that come out of those meetings. Whether it be an income type theme that Roger might cover, or more of a growth theme, or aggressive or conservative. And then what we're doing in Deep Dive is we have created, and we are going to continue to create special allocations, managed portfolio allocations aimed at, again, investors with different risk tolerances and objectives. Right now we have what's called the Idea Vault, which is just a list of all the stocks that we've talked about in Deep Dive from the inception, including our updated buy, sell, hold advice. It's sort of a coverage universe, if you will. We also have a focus list of both income and growth names. These are the most timely names to buy right now across all of the different themes that we cover and like. And we are adding a number of managed portfolios that are going to take that even further. For example, we have in the works an absolute return portfolio. And this is aimed at investors who would like a positive return in any market. And I know that sounds like everybody wants that, right? But there really are two basic sort of columns of investing, if you will. There's relative returns, where you're just trying to beat a benchmark like the S&P 500. And then there's absolute returns, where you're focused on producing a positive return, even if the overall market's down. So a relative return guy would say, okay, well, if I'm down 10% and the market's down 30%, I've done well. In absolute return investing, you're looking to produce a positive return even when there's a bear market. And that allocation, that managed portfolio, model portfolio, is actually going to have specific recommendations, not only for what to invest in, but when to buy it, and how much to put into each of those recommendations. So Deep Dive is going to be a product as service where we attempt to pretty much provide allocations for any style of investor. If you're a long-term investor who doesn't like to be active, you don't like a lot of turnover, there'll be a managed portfolio aimed at you. If you're more aggressive, you want to be more aggressive in managing your money, not necessarily trading, but getting in and out of stocks over the course of a year, several times maybe, then we're going to have allocations for you. And we even have in the works an enhanced income portfolio, which is going to be for those of you who like to trade options to generate additional income from your holdings. So it's really going to cover the gambit there. Capitalist Times Premium is a longer term service. It's more of, if you will, a traditional type of newsletter that you might have seen all through the industry. We do cover a wide range of industries, and we have a model growth and a model income portfolio. Issues there come out twice a month. It's not going to provide as in-depth coverage of the energy market. So if you're looking for really deep down coverage of energy specifically, I would definitely opt for Energy and Income Advisor. And of course, it's not going to provide as many ideas and themes to invest in as, say, deep dive investing. It's a much more sort of general, if you will, kind of digest of our overall thought process, whereas deep dive is, as the name implies, getting much more in the nitty gritty and much more into terms of allocations for individual picks. I know Conrad's Utility Investor, of course, is a much longer term service, but Roger, why don't you describe that one?
Yeah, thanks, Elliot. Yeah, it's Conrad's Utility Investor. I mean, I think the name you can just draw from that. We're looking at essential service companies, so electricity, natural gas, water, communications, and related companies. And I would akin it more to to what we're doing in Energy and Income Advisor. I mean, it's just all things on this sector. It's pretty laser focused. And all the various aspects. I mean, obviously, there's a big income component, and because that's a big part of the returns that you see in many of these industries. But it's again very very much focused on these particular types of stocks, and I think differentiating it from deep dive investing. Obviously, one point of differentiation is that the Conrad's Utility Investor is structured more like a traditional letter, a traditional newsletter advisory that, of course, Elliot and I have been involved with those types of things for many years. But you have feature articles and so forth, and it's very heavy on text. Deep dive investing, of course, we have it's audio visual. I mean, that's the kind of the modus that we're sending out. So, I mean, that would be probably one decision maker for you, is if you enjoy this kind of format where you do get an executive summary, so you know exactly what's in there. You got access to the slide deck, so you can look at these things kind of independently. But it's kind of a different way of looking at things. I think it's kind of liberating for both Elliot and I to present in this format. We've been presenting at major conferences for many years, where we give presentations to investors. We still like doing that kind of thing, and we still do it. But this is a way we can reach all of our readers at once with these same kinds of things. And in fact, anytime we do a presentation, we will make it available on the DDI site and to DDI Deep Dive Investing readers. But it's I think you'll find with this type of format, it really does facilitate a lot of idea generation. We provide a tremendous amount of factual information in these presentations, and I think really the best way to tell what we're talking about, because we can sit here and talk about what deep dive is just to take a look at it. I did want to give. I talked about a couple of names during the presentation, and I wanted to give the readers at least a couple of names here that they can take a look at. And this is just a very small part of what we're doing in deep dive. But I think, again, these are a couple of names if you want to just take have a look at what we're doing here. One would be I mentioned the name in the talk about Yieldcos, and that's 8.3 Energy, and the symbol is CAFD. And again, Conrad, Alfred, Fred, David would be the symbol. And this company yields about 7%. It's growing its distribution about 10% a year. I think it's a takeover target as its sponsors sell. And I think it's in a good place to buy right here under 16, pretty close to in that 15, 16 range. I think this thing could really do well. So that's a Thanksgiving gift to everybody who's listening to us today. And I really hope you'll check out the letter. I do think it's very differentiated from everything else we've done here, not just for the format, but also for, as Elliot explained, a lot of the things that we're talking about in the publication. Obviously, a very wide range of things we talk about, but we do really drill down in these individual areas. A lot of charts, a lot of graphs, and if that's I think it's a great way to get acquainted with good investment ideas.
Yeah, and I don't know if I forgot to mention it, but I would say that Pig versus Bear, which is their other product, this is very much a short-term trading service. I would consider it more aggressive. We trade things like we've used ETFs, exchange-traded funds, to trade things like crude oil, natural gas, the broader stock market, both on the upside and the downside. It's much more of a jump in and jump out. I wouldn't say it's like it's not like a day trading service where you're going to have to sit there and watch flashing colors on your screen all day. But it is the type of service where we try to get in and out of things over a few days to a few weeks. So it's definitely Pig versus Bear is very differentiated from our other services. It's much more short term. It's much more trading orientated. Most of the other services, all the other services, though we may talk about short-term trends, are much more focused on building wealth over the intermediate to long term.
And I'm going to jump in here, guys, and just explain to everyone here what they're seeing on this slide. And we've gotten questions from our subscribers about our founding membership offer here at Deep Dive Investing. So first, I want to just explain that and make everyone aware, we had really planned to close down our founding membership call for Deep Dive Investing this past Monday and Sunday. We did get a lot of responses. I know everyone's busy with holiday travel, driving, flying to get home to loved ones. We did get a lot of calls and emails, over the last few days from longtime readers who kind of missed that call for charter members, again, due to the crazy week. So we've heard that, and we do want to give everyone who wants to join really a chance to join at this lower price point. And so for the next until Sunday, we're actually going to be giving folks a chance to snag one of these 25 seats. So you can see more details here on the slide about the detail on our Forever Guarantee. So, please let us know, give us a call or send us a note or an email, or just go to the website and we'll be sure to put you into that category. Mention to Sherry if you give her a ring, and that's the director of our customer service, and we'll send you that phone number after this call. Mention to her that you were on the webinar and you did want to secure one of those 25 spots. I don't know, Elliot, if you wanted to add anything more here, but specifically the rate here for the Deep Dive subscription at the founding level is a half rate. It's $999 a year, as opposed to the new price point, which is going to be double that. The quarterly price right now is $299 per quarter. That's also going to be increasing to $599 a quarter. And right now we do have an extended trial period, which has gone from 30 to 60 days. And again, the Forever Guarantee, which locks in that price and subscription rate, regardless of what happens here to our pricing as we update that on an annual basis or at our whatever points. You're going to be locking that price in forever. So I'll just open it back up to you, Elliot and Roger, if you want to add anything here, and then we'll get back to a few more questions from folks.
No, the only thing I'd add is that our customer service manager, Sherry, who does take all our customer service calls. We don't use a call center or anything like that. And Sherry, is based in southwestern Virginia, and she does all of our customer service for us. I know many of you on this call have probably talked to her quite a few times. I am giving her Roger and I are definitely giving her a well-deserved holiday over the next few days. So I believe she's going to be on the phones through 5 p.m. today. This is Wednesday, of course, the day before Thanksgiving Eve. But she won't be manning the phones on either tomorrow, Thanksgiving Day, of course, but also on Friday, Black Friday, I suppose, in the old days anyway, we used to call it that. If you want to talk to her via phone about this offer, I'd encourage you to do it today. Otherwise, we do actually have a special website, and I'll go ahead and throw that up on your screen right now. But if you go to that website there, Deep Dive Investing, Hidden in Plain Sight, that will actually, if you want to take us up on the free trial, the risk-free trial offer, that will actually guarantee that you get the rate that we talked about, as well as all the bonuses. There is the toll-free number on your screen, and also you can email us at service@Capitalist Times, and we can answer any questions you have or communicate with you in that way. That's all I'd add.
I have nothing to add to that, except thanks everybody for tuning in, and let's have some more questions.
Yeah. So John wanted to know this. Andarko has dropped a lot this year. He's thinking of buying and wants to know from Roger and Elliot, do you guys like it, or is there a better pick? Pretty straightforward questions.
Yeah, Anadarko I think is one of the better companies. I think what you're seeing, and Anadarko, of course, is a large independent exploration and production company. I think the big shift you're seeing there is that in years gone by, the primary driver of outperformance or underperformance for exploration production companies was production growth. So all Wall Street ever cared about was, how much is their oil production going to grow year over year? Is it 10%, 20%, 30%? And the ones that, and actually I did a chart many years ago, back during the bull market for oil, back in early 2014. And if you plotted 5-year returns against 5-year production growth, it was almost an exact equation. The faster production growth, the faster oil production growth, the better the stock did in terms of long-term returns. That's no longer the case. Investors, with oil prices down where they are, and though we think they're likely to head higher over the intermediate term, the days of $90, $100 oil, steady $90, $100 oil are gone for now, probably gone for a while. The focus investors have right now is much more on not only companies' ability to spend within their cash flow and still generate growth. In other words, their ability to generate free cash flow that they can return to you and me as shareholders in the form of stock buybacks or dividends over time. So that's definitely become the big focus of investors right now. Companies that can, in other words, the cash flow they generate from producing oil and gas, they can use that cash flow to fund the drilling of new wells. They don't have to constantly go out, issue more stock, which this group is absolutely famous for, or go out there and take on all this debt, which this group is also absolutely famous for. You want to focus on names that can generate free cash flow to pay dividends and fund buybacks, and just build a lower debt position. Anadarko certainly fits that bill. As Roger gave out a symbol there for Thanksgiving, I'm going to do the same. Another one I would encourage you to look at would be Occidental Petroleum. The symbol there is O as in Oscar, X as in xylophone. I guess you have to kind of go with that. And Y is yellow, OXY, Oxy. Occidental is another big independent oil and gas producer. They have been very firmly focused on cash flow for years. It's kind of their hallmark. And people hated them at times in the past for that, because they used to always, buy these new properties and then not drill it very aggressively. So they were never producing, the rapid rates of production growth of some of their peers. But they pay a near 5% dividend yield right now, and they have been doing some stock buybacks in the past. We think that dividend's sustainable, and we think it's something that they may actually boost towards the end of next year. They have a huge position in the very low-cost Permian Basin of West Texas and New Mexico. So, Anadarko is certainly a name that we have liked and still like. I'd also have a look at Occidental, which is another name that we like right now. Symbol is OXY.
Great. One more question here from Kenneth. I understand that there is a new symbol for Atlantica YieldCo. Could you provide it? And would you suggest we buy Atlantica or Algonquin? Thanks.
Okay, so all right, so I'll take that one. And Atlantica does have a new symbol, and it's AY. Y is in youth. So they dropped the B out from the middle. So it's no longer ABY, but it's AY. Of course, the big news with Atlantica was the deal between its parent Abengoa and Algonquin, which was the other name you mentioned, Algonquin Power and Utilities. And that involves the crux of that one, and we've talked quite a bit about that one in Conrad's Utility Investor in particular. The big thing there is that they're forming a venture with Abengoa, which is a big Spanish engineering and engineering company that got involved with, or in the words of the CEO of Algonquin Power, got over their skis, I think, with a little too much debt, and is now trying to go back to its original mission. And Algonquin, being a financial partner, will be going around the world with them. They have lots of employees that they are very well connected in many markets. So that's going to create a lot of growth for Algonquin, and also for Atlantica as they drop down assets to Atlantica from what they do. Atlantica has been kind of hamstrung by the bankruptcy of Abengoa. They haven't been able to take full cash flow from some of the projects, and it's a YieldCo. So again, it depends on cash flow from contracted projects. And now that with the Algonquin deal, they have a new parent, so those cross defaults go away, and they've started ratcheting up their quarterly distribution in response. And so we're pretty excited about that one. We have a buy target of 22 or lower. That's still the buy target for it. We also, and that's one of the companies in the YieldCo universe that we've talked about. I think, again, price is important. Algonquin, also a favored name, and in the utility space for us. So we have a target of 11 or lower for that one. So we like both of those. I think if you're trying to decide which one to buy, probably the Atlantica has a higher yield, and maybe more suitable if you're just in it for the income. Algonquin, maybe the more conservative name, because it's about 80% of its business right now is regulated utilities in North America. So which is a very steady business. So those are both pretty solid names. Again, we have been talking about them for a while, so they're not as cheap as they used to be, but and we've done pretty well with both of them, so we're happy about that. But they're, I think, both pretty good names.
Great, thanks, Roger. Well, I think that wraps it up. I think we've answered all the questions we've had come in. I want to thank everyone for sticking around for over an hour with us during a busy week. I hope you all are getting ready to relax or almost wrapping up your travel to be with your family for this holiday week. Before we jump, I do want to just add, before we open up this special, the founding members call to our broader list, the folks here in today's webinar are the first to hear about this. And so I would urge you to take advantage of the risk-free trial if you'd like. We will be announcing our Black Friday special to our broader VIP list for Deep Dive Founders Call in the next day or so here. So thank you all again for joining, and I hope you can tune into our next session here.
Thanks, everyone. Happy Thanksgiving.
And I second that. Thanks, everyone, and we really appreciate you tuning in.
Happy Thanksgiving, everyone. Bye-bye.